Netflix stock is down over 70% year to date, and we are just 7 days away from Q2 earnings over at Netflix. And on today's show, I'm going to give you a preview of those Q2 earnings expected on July 19th. What is going on, investors? Hopefully you guys are doing well out there. When we look at a stock like Netflix that is down over 70% year to date, a company that is profitable, has legitimate revenue growth, and now has seen its valuation and its stock price pull into areas, quite frankly, many investors have never seen before, but also starts to line Netflix up as a stock that we could potentially look to buy. We'll discuss a lot of that on today's show. Now, the first thing I want to do is talk about the Q2 earnings, which are expected 7 days from now on July 19th. The revenue expectations over at Netflix expected to be right about $8 billion. Now, the thing to understand about not only Netflix's earnings 7 days from now, but all the earnings that we'll be talking about over the next month or so is a lot of the expectations have kind of been reined in. So when you see the guidance from Netflix, which we got from the company about 3 months ago when they reported their Q1 earnings, the guidance was for $8.05 billion worth of revenue. At the time, Wall Street's expectations, which is usually a little bit underneath where companies come, including Netflix, expectations at the time were at $8.22 billion. Those expectations have been pulled back. We'll talk about some of the reasons why, including a 2 million subscriber quarter-over-quarter loss that we'll discuss in depth here on today's show. Well, the subscriber numbers have been pulled back. The demand for Netflix has been pulled back a little bit. So now Wall Street is expecting the exact same number that Netflix telegraphed 3 months ago, right about $8 billion. So when you see a week from now that Netflix might come in at $8.1 billion, maybe even as high as $8.2 billion, and that seems like some kind of fantastic achievement, understand that the original estimate that Wall Street had 3 months ago was closer to $8.2 billion. So unless Netflix comes over and above that number, basically they're still disappointing based on the expectations that were set forth. Now, same thing for EPS, which is earnings per share. Over at Netflix, the guidance they gave us in Q1 was right around $3. The current estimate on Wall Street is actually a little under that at $2.97. But when Wall Street gave us this $8.2 billion estimate on revenues 3 months ago, they were expecting earnings to be at $3.04. So if you see Netflix report their EPS, maybe they beat by a penny, 2 pennies, 3 pennies, 4 pennies, they'd have to get above $3.04 to really surpass the expectations that were set forth just a couple of months ago. Now, some of the other key data, I think actually probably more importantly than the revenue and the EPS over at Netflix, let's face it, this company is on a subscription model. Their EPS and their revenue is somewhat easily telegraphed. Really what we're looking for is kind of the forward guidance on, and as you recall, during Q1, when Netflix reported their Q1 2022, we had the first ever loss of subscribers, which was close to about 200,000. And I think Wall Street could have digested that a little bit, but what was even more shocking than that was their guidance for this second quarter, which is a week away now, that they were actually going to lose 2 million subscribers. So they were going to swing from a first time ever losing subscribers in a quarter, and that was going to get worse by a factor of 10 in the upcoming quarter. That is what really sent this stock down and causing analysts and estimators out there in terms of valuation to really factor that into their valuation. So we're going to be looking at that upcoming, so that Q3 number that they'll give it, and Netflix will put out the exact same thing a week from today. We'll see the current subscriber growth. Now, do keep in mind that even though they're likely to shed 2 million subscribers, maybe even a hair more than that, that still does represent over 5% growth year over year on that subscriber side. But obviously, if you start shedding millions of subscribers quarter over quarter, all of a sudden those year over year gains will turn into declines as well. We're looking for that subscriber number to stabilize. Any positive outlook on maybe subscriber gains in the upcoming quarters would be very beneficial for Netflix stock. Now, the other thing that we're looking for updated info on was the company went in depth on their press release last quarter talking about account sharing, particularly here in North America, where they can charge the most per subscription. They estimated the company had over 100 million accounts being shared worldwide, and a significant amount those here in the United States and Canada. We'll see if they've had any updates on that. Also, which I'll talk about in depth on today's show, is their advertising tier. Netflix wants to launch an advertising tier where you can watch Netflix programming subscription free, but have to sit through ads. They want to launch that by the fourth quarter. So we're looking within the next 3 months, this company wants to launch an advertising tier. We'll talk about what kind of partnerships they might need, if they're going to develop some of this in-house, and maybe a membership tier breakdown, including maybe some acquisitions as well. So we're 1 week away from Netflix, and with the stock down over 70% year to date, we start talking about valuation. So first thing that we do when we look at valuation is forget the past, okay? The past now with Netflix, especially if you've never owned this stock. We start to look forward. And what I do is when I want to look forward, I just take a look at Wall Street, okay? Wall Street's not going to be 100% accurate, but it's sure as a heck a lot easier relying on their data and their models and their forecasting than having to do this effort and do this by myself. And we're seeing that Wall Street is estimating over at Netflix, and this is really key. This will be a key discussion on today's video, is they're projecting, this is quarter over quarter revenue growth. I'll even zoom this in just a little bit so you guys can see. Year over year revenue growth on a quarter basis expected to just grow right at those high single digits. So 8-9%. Really into the foreseeable future. So Wall Street has pegged Netflix revenue growth rate at just 7-8%. So off the top of your head, you can think if this company gets into advertising, which would likely bring in large amounts of money on that top line, not necessarily bottom line operating profits EPS, but on that top line, you might see a company that just relied on $12.99, $14.99 subscriptions. Well, all of a sudden they're getting millions of dollars to run ads. That certainly can impact this company's revenue estimates, and we have to factor that in when we get to evaluation, which we'll talk about more here in a second. But I did want to zoom in here as well. I've got full year estimates for this company in terms of its revenue. Again, Wall Street kind of seeing kind of 8-9% growth on a quarterly basis. For a yearly basis translate out to about to be a 10-9% growth rate year over year on that revenue side. If you start looking out a couple of years on Netflix, if by 2026 this company can do about $48 billion worth of revenue, where you're paying just 1.6 times sales for Netflix, which is a valuation, quite frankly, is almost unheard of for Netflix. So speaking of that valuation, I wanted to bring this up here. Netflix is in orange. This is a price to sales chart going back over 10 years over at Netflix. And you see, this is a company in Netflix that is for 10 years almost exclusively traded over 5 times sales. And if you're like me and you think, wow, that's kind of expensive for this company, well, guess what? It's now all of a sudden started to pull back. Not only has it started to pull back, but now it's started to pull back in relation to their peers. So Netflix's price to sales of 2.7 times is quite frankly a little bit similar to Disney's 2.2 times sales. Now, it still trades at a premium to Comcast, which is a 1.5 times sales. It still trades at a premium to Warner Bros. Discovery, which is just a fraction of sales at 0.65 times. You've got Paramount trading at about 0.6 times sales, and Fox trading at about 1.3 times sales. So it's still expensive to a small degree compared to its peers, but not nearly as wildly as expensive as it has over the past decade. That creates some great opportunities, especially if you believe, and again, this is all investor dependent, it all based on you and what you think. Do you think Netflix can kind of outperform expectations in the coming years based on their growth drivers? And what is Netflix's growth driver in the shorter term is creating that ad tier that allows people to watch Netflix, not on a shared account, but generate the company some revenues and some profits from some ad tiers. Now, creating an ad tier on a subscription model, not necessarily rocket science or making an electric car or something like that, but it's not that easy, okay? There's a fair amount of moving parts, and Netflix looks to rely on maybe some external candidates in terms of serving those ads. So when we start thinking of like external candidates, who or some of that could be, certainly Google comes to the top of the mind. You also have the Trade Desk, which I believe signed a deal today with Disney to serve some kind of ads. You also have Comcast that I suppose could team up as well. They have a large kind of ad serving business, but right now Netflix is looking to potentially hire somebody from Comcast and maybe even Snapchat to help lead this ad tier effort. But more than likely, at least on all the rumors that I've been seeing in the ad world, is that Netflix is likely to partner with somebody. I would guess a Trade Desk or a Google would make the most sense. Now, the other thing that complicates this too a little bit is the fact that Netflix has to talk to their Hollywood and studio providers for support for this ad-based subscription. So say you own the television rights to Seinfeld. Well, you license the ability to stream that on a service like Netflix. And in the case of a sitcom like Seinfeld, they're only going to want one ad-supported platform showing Seinfeld. Maybe they want one platform that's a subscription model, and maybe their deal with like TBS or TNT on Syndicate TV doesn't even allow them to show other advertising on Seinfeld programs on platforms like Netflix. So Netflix has to go to the individual studios and see if they can't renegotiate these deals. I'm seeing here, based on a Wall Street Journal article, that Netflix will likely have to be required to pay 15 to 30% more on their contracts for certain rights for TV shows that they don't have specifically written into their contracts, that they can show ads on that. So there's the potential that Netflix launches an ad-based platform, but it doesn't have nearly the content that the subscription platform does. And look, I think that's understandable that the library of content might be a little bit smaller on the ad-supported one versus the subscription model, but these are just some things that you want to think about when we start thinking about demand. Now, the Roku CEO, which has been rumored to potentially pair up with Netflix as Roku's market cap has slipped under about $12 billion. Roku obviously very bullish on streaming TV, saying all TV will migrate to streaming eventually. I agree with this, but I don't think the shift is going to be as fast to like from landlines to cell phones has been over the last 20 years. I think it's going to be a similar type thing, but much slower. Now, some of the growth drivers away from advertising for Netflix, and this is what has me excited about this potentially as an investment, is the fact that Netflix has never really gotten into live sports. Now, it was rumored earlier this year that Formula One was renegotiating their rights and they were dealing with Amazon, Comcast, and Netflix, but ESPN ultimately won out with those streaming rights. So it's interesting that Netflix might get into live sports. That certainly could feed into an advertising business. It also could help them retain and attract more people on a subscription basis as well. I personally think the combination of live sports potentially moving on to Netflix at some point, combined with an advertising model, makes this a far more compelling investment from a price to earnings, price to sales basis as this continues to pull in. I believe there's more growth drivers for Netflix versus some of these legacy media companies, which have quite frankly already gone down this road. Now, finally, some of the things that we'll probably see evidence of in the Q2 earnings is the fact that Netflix has done a little bit of cross controls, okay? They shed 300 employees. This followed a cut of about 150 about a month prior to this. So we should see some evidence, not necessarily in this quarter, but maybe some commentary based on EPS estimates and revenue estimates into the future that factor in that Netflix has done some cost controls. Now, in terms of this stock, from a technical perspective, it has done exactly what a lot of stocks do as they head into earnings. They start to wedge out from a price perspective because the sellers have already kind of placed their bets and the buyers have kind of placed their bets. And now we're waiting on that July 19th date. And typically what you see is kind of a wedge formation or a pennant formation, however you decide to say this, but that's basically what we're forming over at Netflix. And so on the bull case, let's say subscriber growth, maybe it didn't decline by 2 million, and the upcoming quarter, we're not expecting a lot of declines. Maybe they've dealt with the duplicate account issue. Maybe we get some really interesting commentary on the ad-supported tier. Well, all of a sudden, I think you could break to the upside over at Netflix. And if you do that, you're looking for this stock to get above this 191 level. If you don't get above, and I would say solidly, probably up into the 190s, 194, well, you haven't broken above an area that hasn't been tested before with Netflix. If you don't get above that area, quite frankly, we would consider that a rejection of that price, and we're likely headed lower over at Netflix. But if you are getting up above 190, there's some airspace above this one. Obviously, you can easily get back up into the 203s, 204s, 205s. If really good news, I mean, we're talking about the bullish of most bullish Q2 results come in for Netflix, you get above 205, 206 on this one. In my opinion, that actually trigger some kind of momentum buy, because holy crap, you've got almost nothing blocking this stock from getting up into the 220s, 230s, maybe all the way back up into the 240s with that type of momentum. Now, I'm not necessarily anticipating that. I'm just telling you that's what the chart is saying. Now, from the reverse direction, we get a bearish report in terms of subscriber growth, revenues, profits, everything kind of missing the mark over at Netflix. Well, you tell you what, you do have an area of support down here at about $164 per share, but unfortunately, it gets incredibly bleak if you break that mark. I mean, we are only talking about $7 or $8 underneath where Netflix is trading right now. If you get underneath that, we could have another massive type drop. And look, we've seen this over at Netflix. I mean, we went from 343 down to 230. We went from 500 all the way down to 300 after the previous two earnings. So that type of scenario could certainly happen again with Netflix. And depending on the news, depending on the reason why this one fall, I think quite frankly that could absolutely trigger a buying event, because based on what we talked about in terms of valuation, in terms of growth drivers that Netflix has versus its peers as well, I think the risk reward all of a sudden would set up very nicely if you could get some big red candles. That's why I'm not convinced that that necessarily plays out over at Netflix, but we'll certainly find out more a week from today on July 19th. So hopefully you enjoyed this preview. We'll certainly be back again very soon. We'll preview Tesla's earnings, which are due out next week as well. Hopefully you guys have a wonderful day today. Back in soon with more. Good luck with your investments.